absolutely beautiful here at the moment. Let's crack straight into it. This week's been a very, very busy week. We've been doing strategies reviews and running a lot of optimization on the strategies that we operate in, both the managed funds and managed accounts. It's been very, very busy. I was down in Sydney earlier in the week and got back yesterday afternoon to spend the day in Gloucester catching up with people here. First thing, 5 biggest developments this week. We had Swiss PMI falls to a month-on-month change of 0.1%. And it just really does demonstrate once again that the interest rates that they have increased in Switzerland have really started flowing through to their economy. Inflation has definitely come back, and that's also flowing through to their manufacturing index as well. Earlier in the week, we had Australia and the RBA. They held interest rates at 4.1%. The interesting thing that has continued to happen over the course of the week is Australian fixed income and treasury market has continued to sell off, indicating that yields are expected to go higher. So at the moment, fixed income traders are essentially betting that they think there are going to be further rate hikes coming over the next 3 to 6 months. A lot of the volatility that we are seeing in the Aussie share market, like I mentioned last week, has just continued to exist. And a lot of it is because are people thinking that this is the end of the interest rate cycle here in Australia, or is it just merely a pause before we go again? The one issue that can definitely happen is that if they do hold interest rates at a lower level than they really should, the moment it holds for a period of time, people start to become accustomed to this higher interest rate environment, but relatively lower than where it really should be, and they start spending again, which starts to kick up inflation, and essentially it's just a roadmap once again of what happened in the 1970s and 80s. We also had US ADP non-farm payrolls. Expectations were new jobs created of 267,000 for the month. It actually surged to around about 500,000 new jobs created. So this massive surge was really a bit of a shock because everybody wants to see that the interest rates working themselves through the market, which would be slowing down the economy in general. But what we're actually seeing is the US labour market and economy just in general is very, very resilient. And it really does mean that the challenge that Jerome Powell and the US Federal Reserve is going to have is going to be a whole lot harder, because if the economy is going so hard, they know that if they take their foot off the pedal for 1 second, inflation is just going to surge once again, because these numbers demonstrate that businesses and the economy is still growing and still expanding. US services rose 53.9% as a reading. It was against last month's figure of 50.3 and quite a bit ahead of market expectations at 51.3%. And finally, US unemployment claims. We've been tracking these over the last sort of 3 to 4 weeks. They've been relatively consistent between 240,000 to 270,000 new claims on a week-to-week basis. Again, very interesting, because what we ideally want to be seeing to show that there is this possibility of a slowdown is that unemployment to be just gradually and very gradually and subtly increasing over a period of time, because it just demonstrates that the economy is slowing down through the feeling of all these interest rates coming through the market. At the moment, it really hasn't been at the degree that people would like to see, which, you know, if you've had a look at the Aussie market and the US markets overnight, is really demonstrating, or it's really showing this is what people are looking at, because the equity markets are selling off, because the likelihood of further interest rate increases coming up is generally getting a little higher, because the effect of this interest rate increases that they've had over the last 12 months still have not flown through to the economy so far. Cover through FinViz, a selection of futures markets. Again, some of these we trade, some of them we do not trade, but you can see there's been some big performers in oats, orange juice, lean hogs, which again, you know, normally commodity markets are a little bit more volatile than this. but it has been very, very volatile recently. So this week of relatively subdued price action here in some of these commodity markets is welcomed. We can also see down the bottom here, like we spoke about last week, this 30-year US bond has continued to sell off over the last week. And obviously you can see here as well, finally, you're actually starting to see that expectation of further interest rate increases flow through to equity markets. Russell 2000 down about 2.5% for the week. The Nikkei, which has been on an absolute tear for a while now, down 3% for the week. And last night and over the last week, the DAX and the Euro Stoxx down 4% and nearly 6% respectively. Natural gas and ethanol prices have also come back quite a lot. Looking at the Aussie share market, you can see that it's been pretty mixed over the last 3 to 4 weeks. And if you are a more active spectator of the share market, you'll have noticed this week it's down a lot. Last week it was up a lot. The week before that it was down a lot, and the week before that it was up a lot. So it's been going up and down and moving all over the place without really going anywhere. Over the last week, you can see that a lot of the drag was coming from the big 4 banks, ex-CBA. Rio BHP also very poor. A lot of this issue coming through and why we're seeing this continued weakness in these materials is because of the China slowdown and the lack of demand coming in from the Chinese property sector. There's a couple of trains of thought there. You can think that they are going to look at doing some type of stimulus to boost their economy, or the other one is that they're just going to continue to do what they have relatively done, which is trying to reduce inflation whilst maintaining reasonable growth and just not following the same path as they have done in previous years where they aggressively do big packages of quantitative easing. For the Frame Funds Trend Barometer, you can see here we have definitely seen a spike up in short-term and long-term trends, and especially you can see that the long-term trend uptick has reached the highest level as a percentage for the Frame Futures Fund, our multi-strategy fund. It has been in some time, especially over the last 3 months, and if we go back over the last year, it really hasn't reached these levels very often. Generally, there is a direct positive correlation between the number of constituents within the investment universe hitting new short-term trends or making new short-term and long-term trends and the performance of the strategy. Outside of that, hope you have a nice end to the week, and we will catch up next week.